Hello once again. You're welcome to another study session on Buzz 102 Introduction to Business 2. We have had 2 sessions already where we discussed major functions of business, including production and marketing. During our study session 2, you were exposed to some definitions of marketing, and you were all told that it has to do with creating satisfaction, identifying customer needs, and satisfying these needs profitably. We also discussed the different types of the marketing tools or techniques or elements, as we'll call them, that will make you competitive, survive, grow, and expand in this competitive business environment. This session will be looking at the finance function, which is another major resource of an organization. As we all know, it is commonly believed that finance is the life wire of every organization, including the business. Thus, it is essential for the business, the owner, the management to efficiently and strategically manage, that is, plan, organize, direct, and control this particular resource in order to enable the business continue as a going concern so that it can again grow, expand, and develop. By and large, during this study session, we'll be looking at 3 major areas. You'll be made to define finance as well as business finance, and then we'll also define business finance function. We'll also look at, or you'll be able to identify, explain the different areas of this serious function. Furthermore, the study session will cover the explanation on different or the major finance functions. We'll also look at the different sources of finance available to businesses, particularly in Nigeria. By way of intro, let's look at the meaning of finance. Generally, the CFI define finance as the management of money and other related activities such as investment, borrowing and or lending, saving, budgeting, projecting, and forecasting. It encompasses the money or other liquid resources of a business. Mandalika in 2020 looked at finance as the activities related to banking, leverage or debt, credit, capital markets, money, and investment. What is business finance? We're not being specific. Initially, we looked at finance from a general perspective. Now we're going to look at finance as it relates to business. Weston in 2017 defined business finance as the gathering or the sourcing and managing of business funds. Weller, in his own description, looked at business finance as business-related activities concerned with the accession, that is, the sourcing and the management of business capital funds in order to meet the business's financial obligations and other objectives. Now, what is business finance function? This is where the session looks at. We're looking at the major related functional area. Bature and Ojobi define business finance function as the activities that has to do with the proper and efficient management, the proper and efficient planning, the proper and efficient organization, the proper and efficient organizing, the proper and efficient control of the business finance. An online platform, the managementstudy.com, looked at business finance function as a sourcing or acquiring and utilization of the necessary funds. That word necessary is important to this study session. Let me take it again. Business finance is the sourcing or acquiring and utilization of the necessary funds for the efficient operations of the business. Shawal in 2018 looked at business finance function as the acquisition and the efficient utilization of funds in the business. If you look at all these definitions, some keywords: acquisition or sourcing, efficiency, effectiveness are the key things we look at, and that's what management is all about. Now, what are the areas involved in carrying out this business finance function? Now, there are three major areas we should all know. These areas include investment financing, liquidity, as well as profit or dividend decision. What is investment financing? For every business to start up, there should be a capital. And the capital is composed of two, or is from two major sources. Either it's debt or equity. That means sourcing or borrowing or lending to finance an investment, while equity is money from the owners of the business. And so it is essential and is strategic for every business to ensure that they properly balance these two sources, because there's cost to fund. What the business needs to know is whether to take much loan or debt or less loan and then put more of owner's fund. And so the capital, the structure of the investment is important. And so every business person, it's not available funds, it's not every fund you get that you put into the business. It is essential to be strategic about it. You need to know the quantity of debt you need, or the amount of debt you need, as well as the amount of the owner's money that should be in the business. That is the only way you can properly make the business profitable. The second major area of business finance function has to do with the liquidity. How solvent should the business be? At all times, the business should have the ability to meet its short-term obligations. The business should be able to pay expenses, general expenses. The business should be able to service its debt. And so if a business is not liquid, then the business is in danger. And so this is one particular area where every business needs to take serious and strategic decisions. Managers, owners need to be conversant with decisions related to how solvent the business is. Another key area of the business finance function is the profit or dividend decision. Now, these decisions include what percentage of the profit should be shared amongst the owner, or consumed, or put back, or plowed back into the business. This is another serious and strategic area that decisions need to be taken when carrying out business finance functions. The owner or the management needs to be careful and diligent in determining what share of the profit to be shared, or what percentage of the profit to be shared, what percentage of the profit to be consumed, and what percentage to be put back into the business so that it shall continue to expand or grow. Now we're going to look at two major business finance functions. And what we mean by the major functions, we're talking about budgeting and accounting. Budgeting. What is budgeting? For every business to grow, to survive, it is important that the business has a financial plan. That is, a record showing its expected and projected source of income, as well as the sum or expenditure. And so budgeting simply means the business record of expected or projected sources and sum of income or revenue and expenditure for a particular period. It is the business's financial plan for a given period. This is often prepared at the beginning of a financial year in order to guide the business's actual financial activities. And then the other major business financial function has to do with accounting. While budgeting focuses on plan, accounting focuses on actual. That is, it is simply all about stock taking. Especially, it has to do with keeping financial records of actual activities. All business must ensure, at least at all times, to keep basic records of their purchases, sales, expenses or expenditures, investments, payables, credits, debts, and all whatnot. These activities should be performed periodically and aggregated at the end of the business's financial year in form of a financial report. And what these two do, budgeting and accounting, is at the end of the day, you compare the actual to the budget. The budget is the standard. The actual is the accounting. Now, what are the sources of business finance? Majorly, every business has two major sources of finance, and they are broadly divided into internal and external. The internal sources of business finance are usually the funds from within the business. That is, this includes funds that are generated from activities or operations of the business, such as sales or income or profit that are poured back into the business for expansion. Internal sources of funds also include funds that are generated from the sales of some of the activities of the non-profitable assets and other supporting activities. You know, as we all know as business persons, some of our machines might lose value by way of by way of the book value. And so it is essential that these machines are sold off and then the money put into the business. The same with tools and other equipment as well as vehicle. And then some businesses can go into other activities such as consultancy services. And so sales or income made from these sources are generally referred to as internal sources of finance. External sources, on the other hand, refer to funds that are generated from outside the activities and operations of the business. And majorly, they could be divided into two, either equity or debt. Like I stated earlier, equity means fund from the owner of the business that is put into the business, while debt means facility or loans or borrowings taken to add to the business. Specifically, we're going to look at different sources of business funds available to businesses in Nigeria. We have a whole lot of them, but we'll briefly discuss them. One, personal saving or owner's equity. For anybody to start an investment, ordinarily you should have some savings you want to start with. And the general belief, or where we make a lot of mistakes in developing economics like ours, is that most persons do not want to start small. The little savings you have made is sufficient, is enough for you to start small. Most persons want to wait until they're able to gather a huge sum of money before they start investment. But this is entirely wrong. You can start with as little as 100,000. That is your fund, and is good or is fit for micro investment. Another source of finance available to the business is money from friends and family members. And this could be added to what you have. Most persons can go to their friends or family members to ask for contributions or donations or grants or even loans. And so money from family and friends could come in different forms. It could come in form of contribution. It could come in form of grant. It could come in form of loan. And a loan with interest or without interest. And we also look at another major source of finance for the business, which is grant. As it is, with the advent of the coronavirus disease all over the world, several governments have, including the Nigerian government, have made available different types of funds that could help businesses survive these difficult times. And so there are so many grants from the government, from the different tiers of government, including the federal, the state, the local, as well as individuals and associations and organizations that are available to business owners, so long as you're able to meet up with the minimum requirement. Another major source of finance that is available to businesses in Nigeria is called trade credits. Trade credit simply means manufacturers or producers of business giving you their products in advance for deferred payment. That is, they give you this product so that you make sales and then you refund their money to them. That is what is called trade credits. Most times this has to do with the history of the business and the credit worthiness of the business. There are so many big manufacturers that are into this. They give their products to retailers most times or distributors in advance, pending when sales are made, and then these monies are remitted back to the manufacturers. Another major source of business finance that is available to businesses in Nigeria is called the customer or client's advance payments. There are businesses here that when they are available And because probably they have huge customers, some customers pay in advance for the products of these businesses. This advance payment is another major source of finance to the business. The customers or the clients pay you in advance in anticipation that when these goods are produced, you will now give them the goods because you already have their money. It's common, especially with suppliers of construction companies, where, for instance, the rock crushing companies, where they expect you to deposit money in their account in advance for them to truck out whatever you buy from them. And then another major source, although not known to most Nigerians, is called venture capital. Venture capital has to do with some high net individuals that have funds available for investment. Such persons most times would want to invest in high risk businesses with high return, and so they are called venture capitalists. They focus more on areas like energy, technology, or information technology, and what have you. And so these kind of persons prefer to invest in areas where there's high risk because they believe that the higher the risk, the higher the return. And then there's this other source of fund that is referred to as angel investor. Just as we're told in our religious classes, what do angels do? They come in to help. And so the angel investor is available with fund to help an investor or a business person. They make their fund available most times in form of equity, that is part owners of a business. And so they give you fund, you invest, and then in the end can pull out if they so wish. Another very common source of fund that is available to businesses in Nigeria is called the hire purchase. The hire purchase has to do with organizations buying equipment, not paying immediately in full for this equipment. And so they make payment over time. And so there's always an agreement between the person taking over the equipment and the owner of the equipment. The only snag with such arrangement is that it is more expensive it is more expensive than when you are paying cash for this equipment. And so, for instance, if you want a tractor as a farmer on hire purchase, now there will be an agreement between you as a farmer and the producer or the seller or the manufacturer of the machine. You pay over a period, and so you tend to pay higher. And so this is a major source of finance for the business for people who do not have funds at hand to pay immediately for some equipment. Another major source of business finance is called leasing. Now, just like the hire purchase where you pay over time for the equipment, this one, the person leasing the equipment does not have to pay for the equipment. The person is not buying, but instead the person makes use of the equipment for his or her services and pay for the services for the service period, and then returns the equipment to the owner at the expiration of the period. For instance, as a farmer, if you need a tractor to help you plow your farm, you lease the tractor, you pay for the period, and then after the usage, you now return the tractor. That is another major source of business finance. And then we have the bank facilities. Yes, there are so many types of facilities available in the banks for businesses to access, so long as they are able to fulfill the minimum requirement. It could be an overdraft, it could be an asset loan, it could be a machine loan, depending on the kind of loan you want and the kind of business you're doing. But then the only snag around this area is the interest rate. Most of them are negotiable, but then there is an interest ceiling that is always fixed by the Apex Bank. And then another new source of fund that is available to businesses in Nigeria is called crowdfunding, where you generate from members of the crowd. Most times, because of advancement in technology, using the different social media platforms, you could solicit for fund from members of the public or people who can access your platform. And so far, so good. We have been able to discuss a number of sources of fund available to the business. And so for you to access or take advantage of any of these sources of fund, as a business person, you need to be careful. You need to be strategic, because the business is established to make profit and to continue as a going concern. There is cost to every fund that is sourced. And so the owner needs to be diligent in sourcing for, or in adopting or choosing a particular source of fund, because there are some sources that would divest your ownership. There are some that would increase the cost of a business. Now, in summary, business finance function focuses on whether or not the business has sufficient fund to invest and to get optimal return, or it needs to raise some or all fund from external sources. If it has to source fund externally, is it through equity divestment, or that is equity that is divesting ownership, or through debt, or a combination of both, and in what ratio? And so for every business owner, it is important to balance your capital structure. It is important to make strategic decisions based on the structure of the capital. What ratio of debt, what ratio of equity do you need to maximize or optimize return? The right composition of a business's finance is very essential and should be well thought out for optimal performance. Thus, it is all about having the appropriate capital structure, appropriate liquidity, and appropriate profit decision making at all times. By and large, during this study session, we have been able to define finance and business finance, define business finance function, identify and explain the different scopes or areas of business finance function, list and explain the major business finance functions available, especially in Nigeria, and then list and explain the different sources of finance available to the business in Nigeria. Thank you very much. We have come to the end of this study session.